Thank you very much, Lori. And actually, I almost could have put the same kind of slide up as well. I titled this "Are Short Sellers Good for Financial Markets?" But I could have said "Are short sellers villains?" as well, because that's sort of the way they are they're portrayed in the popular press. So I should say we're moving from real estate back to sort of security markets. So there's this terrible double meaning for short sales. Right? In real estate, it's basically the sale of the home for less than the outstanding balance. That's not what we're talking about here. In this case, it's basically selling something you don't own and betting on a price decline and hoping that the stock or whatever it is that you're short selling falls in price and then you cover for a profit. Well, these short sellers are heroes. This is Jim Chanos here. He's well known for uncovering the Enron fraud. And if short sellers are doing things like that, identifying overvalued stocks and helping markets get to the right price for things, then that's the kind of thing we want to have in the market. So we're allocating capital in sort of the right way. Right? And they might also be helping to make markets more liquid as well. Short sellers might be villains if they are driving prices below fundamental value. This is a picture of Daniel Drew, a very well-known speculator from the 1800s, who was well known for basically conducting bear raids on stocks, basically pushing down the stock price by selling and selling and selling and selling some more, and driving the price well below fundamental value in the hopes of making a profit off of people who were not as smart as he was. Okay, so these short sellers are villains if they drive prices below fundamental value, they destroy good companies, or they make markets less liquid in some way, shape, or form. So we're really trying to get at some of these questions, and I must say that the difference between how financial economists view this, financial economists have a view that short sellers are generally the good guys, that they should generally be viewed as heroes. And most of the data is in line with that. And a lot of the popular press and a lot of observers from the outside tend to think that short sellers are villains. So, for instance, here's a headline: Girard again strikes at short selling, says that this is a menace and it should be banned as a practice. Well, it turns out this comes from October of 1931, in the middle of the Great Depression, which was the last time, basically, we had a big fall in share prices and the last time we had a big debate about whether short sellers are really heroes or villains. Turns out that James Girard, in this case, was the former ambassador to Germany, and that seems to be the sum total of his qualifications for weighing in on the contributions of short sellers to the markets. Anyway, but it was a very noisy debate. He basically went head-to-head with Richard Whitney, who was the chairman of the New York Stock Exchange, on national radio. Basically, the NBC radio network at the time basically hosted this debate between these guys. And it was a very noisy. It was very noisy. Anyway, wow, I can't seem to do one here. So let me try this instead. Fast forward to 2008. Okay? I don't know if you remember back to mid-September of 2008, but it was one hell of a week, right? I didn't want to go to sleep that week. I was afraid of what was going to happen the next morning when I woke up, right? Monday, Lehman files for bankruptcy. Tuesday, we bail out AIG. Wednesday, there's sort of seems to be sort of a generalized run on the investment banking sector. Morgan Stanley falls by 25%. Thursday, basically, that's the origins of what became known as TARP, as an attempt to sort of rescue the banks. And on Friday, basically, the SEC temporarily blocked all short sales in all financial stocks for a period of about a month. Okay? And so it's this that we want to investigate to see whether it had the kinds of impacts, whether we can determine whether short sellers are heroes or villains by seeing what happens in the stocks where the SEC actually banned short sales. And what we're going to do is we're going to compare the stocks where they do ban short sales to the stocks where they don't ban short sales, and look at the difference and see what happens in those two sets of stocks. So in a sense, it's a little bit like your standard drug study. We've got a set of treatment stocks, and we have a set of control stocks, right? Stocks that are subject to the drug and stocks that are not subject to the drug. And let's see whether the patient dies, okay? All right? So that's the idea here. Well, can't seem to get it to work. Okay. Now, how did they do this? You might vaguely remember this, but how does it actually work? Well, basically, they put out a list of 797 different stocks. They said they were banning it in 799, but they put it together so fast that the SEC couldn't count to 800. Basically, the list had 797, and they said it had 799 stocks on it. Basically, what happened after that is that firms could apply to be added to the list. So we have about 200 more firms that were added to the ban list later, including some big names like GE, GM, and IBM. They all argued that they had a big finance subsidiary, a big finance arm, and they should be considered financial stocks, right? Fairly credible for GE. GE Capital is a huge part of GE. Fairly credible for GM because GMAC is such a big part of GM. Not so credible for IBM, which does have a financing arm, but you would not argue that IBM is primarily a financial company. Anyway, this was done right away. It was announced late in the evening on Thursday night. It was in effect right away, so announcement and implementation are right at the same time, which makes it very clean to sort of study the effects. And basically, it turns out that it lasted until October 9th. So we have a period of 14 trading days, or a little bit like something on the order of 20 calendar days, where we can look and see what happened in the stocks where short selling was actually banned. Okay? Now, it turns out that to understand the effect of the ban, you need to understand what the exemptions were like. So it turns out that some market participants were exempt from this short selling ban. And that was if you were a registered market maker. So if you were a broker-dealer who was basically making markets, buying and selling in the stock on a regular basis, and you were registered with the exchange to do that, you were exempt. You could continue to do that activity. And if you were a market maker in the options, you could actually trade in the underlying stock to help hedge the risk that you were taking on from buying and selling puts in the options market. And it's also important to know that there were other avenues to taking a bearish position. You could still buy puts. You could basically buy protection if you were an institutional investor in CDS, credit default swaps. You could still short sell ETFs. You could basically do an over-the-counter total return swap. You could go some jurisdiction where shorting wasn't banned. There were a few. Tokyo, for instance, didn't ban shorting. So you could always go to Tokyo and short sell Citibank over in Tokyo, for instance. So there are a lot of reasons to think that there might have been some ways around this, and this wasn't a complete and total ban. But let's look and see what happened. Okay? Now, I should say, before we go see what happened, let's remind ourselves what happened on Friday, September 19th. Friday, September 19th was one crazy day. All right? In addition to the shorting ban, it was a triple witching day, which was a day that all these monthly options and futures were all expiring. There were some additional things. We also threw some other sand in the gears by requiring short sellers to report some of their positions. Right? That turned out to be overturned and never actually implemented. But on that Friday, a bunch of hedge funds thought the SEC was going to know exactly what they were short selling and exactly when. Hank Paulson basically came out with some more stuff on TARP. We had a run on the money market fund guarantee system, right? So we basically were backstopping a bunch of money market funds. The Fed was basically in a similar way backstopping asset-backed commercial paper because that suddenly was experiencing a huge run. We increased the kinds of collateral that could be posted at the Federal Reserve on all of its various liquidity and lending programs. So it was one crazy day. And the reason I point this out is that when we're interpreting what's going to happen, we need to be very careful about confounding effects. Right? We don't want to ascribe everything to the shorting ban if other stuff was happening at the same time. So we've got to be very careful in thinking about what effects are due to the ban and what effects might be due to other things that are going on at the same time. So what are we doing? This comes from a paper with co-authors Eckert Boehmer at the University of Oregon and Xiaoyan Zhang at Purdue University. We're basically going to look at the ban's effects on shorting activity, stock returns, and market quality and intraday volatility. Okay? And like I said before, we're basically going to compare this treatment group of 800 banned stocks to a matching set of non-banned stocks. And I'll tell you a little bit about how we're going to do that matching. We use a bunch of interesting data, the main one of which we were able to get data from the exchanges on every short sale that came across their systems. So we basically have every short sale for 3 months before, during, and after the ban, and that helps us measure exactly what these short sellers are doing, how much they were active, what they were contributing, were they contributing to markets, and things like that. Okay? Out of the original 800 firms, actually, out of the original 1,000 firms, 800 plus 200 added later, we do a couple of filters. We end up analyzing 727 of these firms. Okay? How do we match? The whole idea is to try to get a control stock that is very similar in every respect possible to the treated stock, the banned stock. So what are we matching on? We make them trade on the same exchange. We make them either have options listed on them or not. Okay? They need to have similar market cap. Whoops. They need to have similar dollar volume. And basically what we do is we find the one stock. It's a one-for-one match. For every band stock, we find the closest stock along all of these dimensions to match it with. Okay? And then we just are going to look at how the treatment stocks and the control stocks behave. We actually use a regression approach to do this. There are a couple of other control variables in there. But rather than show you tables with complicated regression things, I'm going to do proof by graph, because all of the results here are very obvious just from looking at the graphs. Okay? Well, here, let's start with my duh slide, which is when you ban shorting, what do you get? Less shorting. Okay? So you'll see this. Okay? Let's focus here on the large cap stocks. The matching stocks are in red. The blue stocks are the band stocks. Sure enough, you see less shorting. Okay? What you see, actually, is that the shorting used to be about 30%, 25% of volume for these stocks. And while it was banned, it dropped to something like 5% of volume. Right? I want you to realize that this is a big number. Right? 25% of trading volume out there has a short seller behind it. There's a huge fraction of trading volume that has shorting at its root. Okay? And what is that? Are these all the Chainoses of the world? No, these are not all the Chainoses of the world. There are a whole lot of high-frequency traders out there, the Getcos, the Renaissance, various other Wall Street trading firms as well, who are basically short-selling a lot. And a lot of their short-selling is this kind of market-making activity. They're buying at the bid and selling at the ask and hoping to make just a penny on every trade and providing liquidity to the market. What happens is we basically ruled them out with this ban. They could no longer trade during the ban, at least in these affected stocks. And that's what you're seeing here. And what else is apparent from this is that the effects are not present in the tiniest stocks. Okay? So what are these stocks over here? These are basically your small community banks that happen to be on this list. Okay? But they were very tiny. They don't trade much at all. They're very inactive. They're not being traded algorithmically by these high-frequency traders. They are being traded in the traditional way with a market maker who's answering the phone and doing the kinds of trades that come along from the outside. So what you see here is that basically there's no effect. Those continue to trade in exactly the same way. So this shorting ban really had an effect on the large stocks and not much of an effect at all on the short stocks. Now, what do we see in terms of prices? Well, what's happening here? Well, we basically have this is the cumulative return on the stocks that were subject to the ban. This is the cumulative return on the control stocks. Okay? And this, I don't know what to call this. This gray line up here is basically the difference. Well, what do you see? Basically, the stocks that had a shorting ban experienced a price bump. Okay? But that price bump doesn't look anything like what you would expect from a shorting ban. Because if it was from the shorting ban, what you should see is a temporary bump, right? And then as soon as you're allowed to short again, that bump should end. Okay? So we should see a temporary effect. And the fact that we see a permanent effect says, aha, confounding effects are going on here. Okay? So what's the confounding effect? It's all this other news. In fact, I think what we just did here was we just measured the value of TARP and all the other various things that were announced about this time. That basically TARP was worth about 20% of the market cap of the financial sector, and that's exactly how much we subsidize these guys. Okay? So that's, I think, what we're measuring here. And so we don't want to say anything about whether short selling arrested a decline or anything like that. It doesn't look like it basically stopped a bear raid or arrested a decline. It looks like it's all the other stuff, TARP and the Fed Reserve programs and all those other things that accounted for these price effects. There's one other thing we can look at. Well, before we do that, let me just mention the one thing where I think we can say something about this is, remember I said we had these 200 stocks that were added themselves to the list. Those were on days that weren't quite as newsworthy as September 19th. So maybe we can say something about what happened to them when they got added. And if we look at their performance, this is their cumulative return relative to their matches. Basically, they underperformed their match sample. In fact, by the time we get to the end of October, they've underperformed by 20%. Okay? So what does this say? That basically, once you got yourself added to this list, basically you saw terrible performance in your stock. So there's no stock bump, there's no price bump here. It didn't seem to raise prices in any way, shape, or form, this shorting ban. In fact, it seemed to hurt these companies. Well, this is not saying that a shorting ban would actually hurt these companies, but there's a signaling effect going on here. Basically, if you ask to get on the shorting ban list, well, probably why did you do that? Maybe you have something to hide, right? And in fact, the market said, well, if IBM wants to be on this list, why don't they want me shorting them, right? Maybe they have something to hide. Maybe their earnings aren't going to be very good. And so what this is consistent with is stocks that did have something to hide, where that something to hide actually came out over the next month or so. Okay? So in a sense, it suggests that CEOs should be very careful about what they wish for. They shouldn't ask for shorting to be banned in their particular stocks, because that may not have all the benefits to their share price that they think it will have. All right? One other thing to show you basically is what happened to market quality. Okay? And so how do we going to measure market quality? We're going to measure market quality with something known as effective bid-ask spreads. And what's an effective bid-ask spread? Well, basically, we have stocks are quoted by dealers in the market, right? There's a bid price and an ask price, okay? And basically, you might trade at these prices, or you might be able to find somebody in between, right? You might negotiate a trade that's in between the bid and the ask price. So what we do is we basically say, well, where was the trade? Well, let's say the trade price happened right here, okay? What do? We're going to measure, basically, we're going to use this ask and bid to measure something called the midpoint, between the quote midpoint, and then the spread is basically going to be this distance between where did the trade take place and what was the existing midpoint at the time. So that's going to be our measure of liquidity. The wider this is, the more people are paying to execute their trades. The smaller this quantity is, the people are not paying very far from the midpoint. People are not having to pay very much in cost to buy or sell these particular stocks. Okay? And what do you see? Basically, again, the graph shows everything, and the regression results basically confirm this completely, is that essentially the spreads on the banned stocks blow out relative to the spreads on these control stocks. So there's a huge difference here. Again, it's limited to the big cap stocks. Remember, there was really no effect on shorting, so that you wouldn't really expect to see an effect on the market quality. But down here, these spreads got incredibly wide, very, very wide, in a sense, like roll back the clock 30 years of financial development-wise. You know, we rolled back the clock to spreads that we last saw in the 1980s here in the U.S. Okay? So it was an incredible degradation in market quality for the stocks that were subject to the ban. And the story is, basically what we did was we took out these market makers. We took out the Getcos. We took out the Renaissance. We took out the people who were supplying liquidity, who were high-frequency traders who were adding to the market. And because they weren't allowed to trade, our market quality was really bad, and the people who were left over were able to basically post much less competitive quotes and basically retain much more in the way of rents. And it made things much more costly for people who were trading on the outside. So the conclusions really here are, you know, short sellers help to get prices right. They make markets more liquid, and basically we should be embracing them rather than shunning them. And in hindsight, basically, you know, at least some of the commissioner, the smiling Christopher Cox over there, basically confessed in December 2008 that this was the biggest mistake that he had ever made during his tenure. And basically, Commissioner Toy Paredes basically said, we got the costs, but we got no benefits. All right, so essentially a lousy idea. Now, having said that, my guess is that the next time we see share prices fall, we're going to see another effort by people to rein in the short sellers. So all we can do is, as economists is basically show the effects, and hopefully people will see these effects and see exactly how bad these effects are, right? And hopefully that will keep people from doing these crazy kinds of interventions in the market. But I hold out no hope that will actually have an effect completely on the political process, because short sellers are just too easy to scapegoat. It has happened all the time, and my guess is it's going to continue to happen down the road.